Now, when starting a cannabis business venture, whether it's your first one or it's your 20th one, you're gonna have to choose a type of entity to house that business. Now, there are implications for each entity type, revolving around risk, taxes, as well as cash flow to the entity holders and owners. So, in this video, we're gonna talk about some of the considerations that you should think about when selecting your entity, as well as how to pull money out of each entity type and the tax implications for each of those methods. Now, if you have any questions about cannabis business taxes or need help with your cannabis business accounting, entity selection, or a tax strategy, then please reach out to us via our website at greengrowthcpas.com or give us a call at 800-674-9050. Let's hop right into the presentation. So again, today's topic is how to get money out of your cannabis business, and this presentation is brought to you by Green Growth CPAs. Now, one of the biggest questions we get asked is, how do I structure my cannabis business and how do I get money out of my cannabis business? So we want to walk you through some considerations for structuring your entity, as well as how to get money out of your cannabis business in the most tax efficient way. And before we get started, I need to let you know that the information in this presentation is meant for guidance purposes only and not as professional legal or tax advice. And further, it does not give any personalized legal, tax, investment, or any business advice in general. So with that out of the way, let's review what we're going to cover in today's video. So first, we're going to talk about entity selection considerations, and then we'll talk about Cannabis C-Corporations and methods to pull money out of those. We'll talk about Cannabis S-Corporations and methods to pull money out of those, and then we'll discuss Cannabis LLCs. So first, let's talk about entity selection considerations. Now, this is not the full list, but these are the chief things you should be paying attention to. Now, entity selection is a function of two main chief considerations, risk and cash flow, or deal economics. Now, with the first factor, risk, you want to make sure that you're insulated as much as possible from any risk due to conducting your business. Now, you may have heard of what we call the corporate veil, which is a legal concept that separates the corporation from its shareholders and protects them from being legally liable for the company's debts and other obligations. But this protection is not ironclad or impenetrable, where a court determines that a company's business was not conducted in accordance to provisions of corporate legislation, or that it was just a facade for illegal activities. It may hold the shareholders personally liable for the company's obligations under the legal concept of piercing the corporate veil. Now, this is where your lawyer comes in and they can give you the best guidance on risk mitigation. But the second consideration is going to be the cash flow and the deal economics, essentially how the money moves around and how it's taxed. Now, you'll need to model this out on Excel or Google Sheets, especially if you have multiple entities in your cannabis business, different owner involvements, and many other factors. Now, the economics of the deal always trumps the tax implications of the deal. You want to make sure that the money is going to the right people in the right percentages according to your operating agreements. Now, pretty much you're going to ask yourself, once profitable, how do we split up the money? Now, once the movement of the money, the profits, the losses is mapped out, then the next part is to think about the tax impact of your entity selection and how you pull money out of that corporation or that LLC. Now again, this comes back to modeling out the scenario. Now, this can take quite a few iterations to work on, so make sure you're patient and work on different scenarios with your CPA or your financial manager. Now, there are many other considerations, but the last two I will leave you with is how are you going to exit this business, what's your plan for exiting, and your time horizon for that. For example, with Horizon, pass-through entities may give you a better tax advantage for the long term, but a C-Corp gives you a capped 21% tax rate that may be more advantageous in the short term. And an example of an exit plan is that if you want to take this company public at some point, you cannot do that with an LLC. You're going to need a C-Corporation. But again, entity selection is based on many, many factors. These are just four chief ones to consider and to look at, and there's a lot more to consider when you look at your deal. So each case is unique, and there's no one-size-fits-all for any situation, so make sure you work with your lawyer and your CPA to decide on what entity structure is right for you. So this brings us up to our first entity, which is Cannabis C-Corporations. Now, when you set up your cannabis venture as a C Corp, your business is owned by individual shareholders who have equity in the company. And these shareholders, they vote on decisions related to growing and running the company, while a board of directors has the power to make final decisions. Now, as a C Corp, your cannabis business venture actually pays taxes on any income less particular expenses. Of course, we got to have the nuances of 280E. Now, the entity itself is considered a taxpayer. And when you compare this to an LLC or an S-Corp, where income gets allocated to the owners who then pay taxes on their personal tax returns, you start to see the risk in withdrawing any kind of cash outside of a C corporation is that you may face double taxation. And with cannabis, it can seem like triple taxation with 280E. So let's dive into it. What is double taxation? Double taxation occurs when your corporation has some type of accumulated profits. And then double taxation is a tax principle referring to that income taxes are paid twice on the same source of income. For example, your Cannabis C-Corp gets taxed on the income it made from performing well and earning a profit, and then you get taxed on your personal tax return on, say, a dividend or some type of wage that you received as a result of that profit. Now, it's not the ideal scenario, but that's just the way that C-Corps work. Now, there are a few ways to mitigate double taxation, but with cannabis, of course, we have to consider 280E. Now, depending on your vertical and what services and effort was put forward by the person getting compensated, some types of compensation may be deductible under 280E. An example of this would be a salaried founder who works as a master grower 80% of the time. In this scenario, potentially 80% of their salary could be deducted from your Cannabis C-Corp's revenue, and the individual gets taxed at their marginal tax rate. So now that you understand what C-Corps are and how they're taxed, let's talk about ways to get money out of the C-Corporation. So first, let's talk about dividends. Profitable C-Corps can pay their shareholders dividends at the discretion of the board of directors. Now, this is one way to withdraw money if you're a shareholder with no direct role in the operations of the Cannabis C-Corp, and therefore not a salaried employee. Now, shareholders do not have a right to dividends, and you may face double taxation, but that's one way to get money out of your C-Corp. The next one we're going to talk about here is shareholder salaries. Now, if you're a shareholder in a Cannabis C-Corp, the easiest way to withdraw money is to list yourself as a W-2 employee, and then when you set a salary, make sure it's reasonable for the amount of your job's roles and responsibilities. This is called a reasonable salary. You can't pay yourself $10 to be the CEO. So, if you're unsure about what a reasonable shareholder salary should be, go ahead and do your research for positions and compensation levels at comparable companies in the cannabis industry. And if you need help with this, reach out to us and we can walk you through a framework to understand what a reasonable shareholder salary can be. Now, a bonus step to this particular aspect is to make sure that you include in your employee handbook or your job description what this person will be responsible for and explicitly state what category of tasks their time will be spent on. For example, 20% of their time will be working in the grow spaces, improving the product, and then 50% of their time is doing business development, and 30% of their time is doing something else. This helps with the 280E allocations that your CPA will need to do for your cannabis business when you file your tax returns. The next way to get money out of your Cannabis C-Corporation is to have benefits and expenses reimbursed to you. Now, you can have certain costs reimbursed by the C-Corporation, provided that they are at least partially related to the business. For instance, benefits such as health insurance, life insurance, car rentals, smartphone and laptop costs, and other business-related travel and utilities can be reimbursed by the C-Corp. You want to make sure that you avoid non-business related expenses such as entertainment tickets or school fees for your children, as the IRS will likely flag these costs as non-reimbursable. And again, with 280E, if you want this to be deductible to the corporation, make sure that you can reasonably allocate this to COGS. And this is where you need to speak with your CPA, because with certain expenses, you may be able to deduct them reasonably, but you just have to have, again, that reasonable methodology for allocating. So speak with your CPA or your finance manager about that. Now, the next one is going to be non-dividend distributions, and these are also known as capital distributions. And this method of withdrawing money happens when the corporation refunds a portion of capital contributions shareholders have made to the company. For instance, if you paid a portion of the startup expenses for your cannabis company, you may be able to receive a non-dividend distribution repaying you for those initial expenses. Now, this type of withdrawal, in most cases, should be non-taxable. And the last one we're going to cover here is a shareholder loan. Now, it is possible to receive a loan from your Cannabis C-Corp, but the terms of the loan must be approved by the shareholders holding a majority stake in the company. The tax liability with this is a little bit tricky and must be looked at on a case-by-case basis. But the loan terms must appear in the loan agreement and include a promissory note signed by the corporation and the shareholder that is receiving the loan. Now, the repayment terms and the interest rate should reflect what we call an arm's length negotiation between the borrower, shareholder, and the corporation. Now, this means that your repayment terms and your interest rate should be fair and around market terms, right? You can't get some kind of sweetheart deal because you're a shareholder of the company. It needs to be at market terms. Now, this is not a full list of all the ways to pull money out of your Cannabis C-Corporation. There are many other creative ways to get money out and avoid potential double taxation, but these are the basic methods that you should be aware of when you think about a C-Corporation. So now that we've covered C-Corps, let's talk about S-Corps. Now, there are many ways to take money out of a Cannabis S-Corp, and some of these methods aren't really different from getting money from your C-Corp. However, S-Corp entities don't contend with the double taxation issue that we discussed for C-Corps. So this brings us to the question, how are S-Corps taxed? Well, S-Corps don't pay corporate income taxes, so there's not really an S-Corp tax rate, how there is that 21% for C-Corps. Instead, the company's individual shareholders split up the income, the profit or the losses, amongst each other and report it on their own personal tax returns. Remember, the S-Corporation is a tax election. This means that a corporation, LLC, or LLP is created at the state level and then elects to be taxed under the S-Corp heading. Now, these businesses that are S-Corps can have no more than 100 shareholders and only have one class of stock. So you begin to see why S-Corps are not good for going public. You're going to have a lot more than 100 shareholders. So now that you understand how S-Corps are taxed, let's talk about how to get money from an S-Corporation. First is going to be an S-Corp salary. Now, like a C-Corp, you can take wages from an S-Corp, and you can earn a reasonable salary for work that you perform and take a paycheck with employment taxes that are withheld. But compared to a C-Corp, reasonable salaries are a must with S-Corps. So the IRS requires S-Corp shareholder employees to pay themselves a reasonable employee salary, which means at least what other businesses pay for similar services. Again, you can't pay yourself $10 per month to be the CEO of $1 million corporation. That's not reasonable. And there are methodologies and ways to research what's reasonable for your type of business and your industry. And if you have questions about that, reach out to us and we'll help you with that. The next way to get money out of your S-Corporation is going to be an earnings distribution. Now, distributions are not the same as dividends. S-Corporations are able to make tax-free, non-dividend distributions on the provision that the distribution does not exceed the shareholder's stock basis. Now, note that if you take a distribution in excess of your stock basis or the amount of the company that you own, this amount could be taxable as a long-term capital gain. The next one we're going to talk about here is a loan. Now, most of the same rules apply for taking a loan from an S-Corporation the same way it does to a C-Corporation, which we talked about in the previous slides. Now, if you wish to take a loan out from your S-Corp, you again must have a promissory note and have some type of normal lending terms that include a fair market interest rate and a schedule for your repayment. Now, failing to do so will likely result in some tax penalties. So make sure when you do these loans, they're buttoned up the way they need to be. And lastly, you have also reimbursement of expenses. Now, S-Corp shareholders can also have business-related expenses reimbursed to them similar to a C-Corp, and the same considerations. Make sure it's business-related, it's not personally related, and make sure you have 280E in consideration when you're making particular reimbursement requests, and to see if you can allocate that to cost of goods sold. But that's not always the case that you can allocate the cost of goods sold. It's just a plus to be able to reduce the tax burden for your personal taxes, since S-Corps are pass-through entity types. And lastly, this brings us up to Cannabis LLCs, or limited liability corporations. And with an LLC, it's a business entity in which the individual members are protected from liability within the business, as long as the business is registered with the state and obeys state regulations. Now with cannabis, you also have particular cannabis regulations you have to stick by. We haven't seen cases yet where piercing the corporate veil because you don't follow cannabis regulations, but surely keep this in the back of your mind and speak with your lawyer about it. Now, one thing to consider is that the tax liability flows onto the member or members of the LLC. Now, in the case that you lose a tax audit for your Cannabis LLC and you owe some type of additional taxes or penalties once that audit is all said and done, then you may be potentially on the hook and become personally liable to pay that tax bill. So, yes, LLCs sometimes seem a little bit easier, but in the case of an audit, you may be stuck with that tax bill. And there are two main types of LLCs. You're going to have the single member LLC, which is one person, or an LLC with multiple members. Now, the tax repercussions for these two types, the single member and multi-member LLCs, and the ways that you withdraw money, they vary slightly between the two, and I'll get to that in a moment. But it's important to understand that when you take money from your Cannabis LLC, you draw money from a capital account. And this is not the same as taking a paycheck. There are no federal or state income taxes or FICA taxes withheld from your draw from the LLC. But that doesn't mean that you avoid taxes. As the owner and member of an LLC, you don't get paid, again, a salary or a wage. Instead, you pay yourself by taking money out of the LLC's profits as needed. Again, this is called an owner's draw, and you can simply write yourself a check or transfer money from the LLC's bank account to your personal account, and it's easy as that. And for federal tax purposes, a single member LLC is treated the same as a sole proprietor, and a multi-member LLC is treated as a partnership. In either case, a limited liability corporation's profits and losses pass through to its owners. The main difference comes down to self-employment tax. Now, with a single member LLC, the LLC member must also pay self-employment taxes, Social Security, and Medicare on all taxable income from the business. Income taxes like this are usually paid via quarterly estimated tax payments, and don't forget that other fees, such as franchise fees that LLCs must pay, could be due as well. For example, in California, there is an $800 minimum fee to have an LLC in the state of California, no matter how much money you make. But with multi-member LLCs, here's the difference, and here's the kind of negotiation back and forth. Many LLC members have taken the position that they're equivalent to limited partners, and therefore they're exempt from self-employment tax except on guaranteed payments for services. But there's a big difference between limited partners and LLC members of a multi-member LLC. Again, both are going to enjoy the limited personal liability, but unlike limited partners, LLC members can actively participate in the management without jeopardizing their liability protection. Now, LLC members who are actively in management or perform substantial services related to the LLC's business are subject to self-employment tax, while those who more closely resemble passive investors should be treated like limited partners. And just like single-member LLCs, profit and losses pass through to its members or its owners, and other fees such as franchise tax fees may be due. Example again is that California minimum $800 tax for the LLC. Now, hopefully this presentation has brought you some value and helped you to understand a little bit about entity selection and how to take money out of your cannabis business. So if you need help with structuring your cannabis business or developing a tax strategy for your cannabis business, then please reach out to us via our website at greengrowthcpas.com or give us a call at 800-674-9050. We've helped hundreds of cannabis companies walk through the exercises of modeling out their entities, showing how money moves around the business, and then planning a tax strategy that puts you in the best position to reduce that taxable burden depending on your specific details of the scenario that you're in. So if you need help with structuring your cannabis business or planning a tax strategy, please reach out to us via our website at greengrowthcpas.com or give us a call at 800-674-9050. Have a great day, and we'll talk to you soon.